Welcome back to Indianomics. We are discussing the double trouble that the Indian macros are facing. Inflation is rising and at the moment at 7.6%, the last reading for January, and industrial growth is contracting. The last number for December coming in at minus 0.3. I've been speaking with three important economists, Sudipto Mundle, Soumya Kanti Ghosh and Prasanna. Gentlemen, thank you for your patience. Dr. Mundle, okay, let me start with the banker first. Prasanna, at a time when inflation is rising, should the RBI persist with its effort to bring down the yield curve, to bring down the term premium? Is that a contradictory signal to send?
Well, I think RBI's own forecast is that inflation will come down. So, I mean, obviously their actions, I would assume, are predicated on that forecast. And also, if you look at what they're trying to do, I think it is the past rate cuts which have not been transmitted by the banking system. And I think you have to understand that the latest round of actions is by and large aimed at the banking system. Of course, the bond markets have also rallied. But the idea is to try and bring down the lending rates. So I think what they're trying to do is just to complement their earlier rate cuts and try and improve transmission in the banking system. And I think the governor also made this point, I think. So if they definitely have a forecast that inflation will come down. Now, of course, the MPC is not able to act on rates because it has already reduced rates by so much and it wants to be cautious now. But from a transmission point of view, I think RBI feels that since it does have that confidence that inflation will come down later in the year, it can take these additional steps.
Okay, but now their 6.5% inflation forecast for Jan, Feb, March may have to be revised higher, you think?
It will have to be revised higher. So I think this has been a persistent problem with the RBI's forecast from last year itself. Of course, at the time when they were cutting rates, I don't think too many people pointed out or were actually bothered also, because everyone thought that rates were quite high and they have to be cut. But consistently, I think over the last year, RBI has been underestimating inflation. I guess previously their model was overestimating and they've done some correction, but now it's on the other side. So I think this year also probably now they will have to revise up their inflation forecast. Our sense is that in the second half of fiscal also, inflation might at best converge back to 4%. It won't go below 4%.
Okay, so the forecast of 3.2 and 3.8 not happening. But Soumya, how can a banker react? I mean, you think of a pensioner, think of any depositor. When inflation is running at 7% and food inflation is running at 14%, can you really cut deposit rates? I mean, won't transmission get jacked anyway?
No, yes, I think... I think before that, I just want to add to Prasanna's point. I think the RBI forecast of 6.5% for this quarter and next quarter is at 5.4%. So our estimates are 50 to 100 basis points higher than that. So based on that, I think inflation will have to be estimated upwards later. But coming to a specific question on the cut of depositors, I think, yes, it's a difficult part because as of now, and inflation numbers is unlikely to subside significantly to below 7% for the next 2 months, and next 6 months it will continue to remain elevated. So that's why the RBI is trying to do these unconventional steps so that basically the banks can have the option of trying to bring down the cost of funds without taking recourse to cutting the deposit rates. And also the fact that if you look into the small savings number, it's at 2.95 lakh crores is the gross collection, which is 25% of the incremental bank deposits last year. So that's not a small number. So I think materialistically speaking, it will be very difficult for the government to cut small saving rates because at a point of time when you are trying to influence the bond market through unconventional policies, I think this could be also one of the ways which the government would like to influence the yield. So my sense is that it will be difficult to cut rates and the RBI increasingly will take unconventional steps to control the entire yield curve structure within the system.
Okay, no, I mean politically I think it would be very difficult for a government faced with 14% food inflation in a country where the CPI is actually 50% food. To cut interest rates. I don't know if I'll have time to come back to that issue again to Prasanna, but Dr. Mundle, the larger question I have, and in fact the most important question is, we have terrible macros now. our fiscal deficit has gone for a toss and inflation is very high. The only consolation is crude is low and therefore current account deficit is completely under control. At a time like this, if the Reserve Bank were to go on with this kind of sloshing of liquidity in the system, are we opening the gate to some kind of financial instability? Are we vulnerable to an external attack if something goes awry in the global markets?
Yeah, actually the RBI is caught in a bind because, as you know, we follow this rule of thumb, the so-called Taylor rule, and sometimes when inflation is too low or your growth is too low, you say that you should raise rates. When they are both too high, you lower rates and so on. But in this case, these two components are pulling in opposite directions, The rising inflation suggests that you should raise rates. The fact that growth is still very low and the latest IIP figures which suggest that you lower rates. So the RBI does have a problem and that is why I think they have paused. But I think now things are tilting in favor of giving greater importance to inflation. And after all, if you, as you know, in terms of their memorandum with the government, the main response is actually not growth, it is inflation. And they have to address the inflation issue first. And whatever their models are telling them is to overestimate inflation or they're underestimating. But I think they're going to be more or less compelled to take the inflation issue seriously, and possibly they might again think about ending the pause and raising rates.
Okay, all right. Now that's Prasanna. Anywhere in your horizon, are you seeing a change in stance for the Reserve Bank in a policy or two?
I think before that, there could be one other issue for RBI. I mean, in our forecast, actually, for 9 or 10 consecutive months, we see inflation above 6%, which means as per the RBI Act, actually, they will have to send a report to the government explaining why it is so and what remedial actions they're taking.
Yes.
Now, of course, obviously, these are slightly far-out forecasts are subject to bands of confidence, but this is definitely within the realms of probability. Now, if something like this comes up, definitely, I think, like Dr. Mundle was also saying, I think the MPC will have to take it more seriously. And therefore, yes, I think both the stance and forward guidance, I do think that there is a possibility they can get tweaked. Now, the issue for RBI, I think, is the MPC is that the growth concerns are still very much relevant. I think this quarter, again, growth, the momentum is actually quite weak to start off with whatever data we got for January. That was before the coronavirus impact. Now, when you add that supply hit to that, I think this quarter, again, growth is going to be a write-off, and probably the economy will enter next quarter with a very weak momentum. So therefore, I don't think RBI or the MPC can quickly tilt from accommodative to a tightening stance. Probably they can go towards a neutral kind of a stance, but I still think growth will have to gain precedence at this point of time. And I think both the RBI and MPC are cognizant of that.
No, I take your point that growth is going to be weak also because the transfers to states is cut rather seriously by over 1 trillion. Your own report, Prasanna. So even that can, perhaps create some liquidity choking problems. But quickly, I want to ask the same question that I asked Mundle to both you and Soumya. Just 30 seconds. I'm sorry, I'm out of time. Do you think we are opening ourselves to some kind of financial attack problems at a time when two macros, fiscal deficit gap widening and high inflation, only current account deficit is behaving itself? Are we slightly more vulnerable, Prasanna?
I mean, it completely depends on external factors. I think right now, externally, it's an environment of slightly weaker growth because of what is happening in China, and therefore global central banks are continuing to keep the policy stance dovish. And therefore, in this kind of scenario, I don't expect any external vulnerability to surface.
Okay, that's good to hear. Soumya, should we worry about financial instability?
No, as of now, I think the global vulnerability actually has increased in the last 1 month or so. In fact, the outlook, which was somehow pragmatic at 1 month back, now it has actually tilted to the negative side. So from that point of view, I think given the global uncertainties, it will be difficult for any kind of financial vulnerability as of now. So, but we should keep a close watch on the external factors, which is likely to impinge more in the coming days.
All right, gentlemen, completely out of time. Thank you very much, Dr. Mundle, Soumya Kanti Ghosh, and Prasanna. Well, key takeaways are experts are not still terribly worried that there could be a financial instability issue with two of the key macros, inflation and fiscal deficit, going awry. But clearly they are worried that the number of tools that the government and RBI have to kickstart growth are becoming fewer and less effective. We wrap up on this edition of Indianomics. Thanks for watching.